here, and hopefully he'll grab that microphone over there, and he'll introduce the group and everybody else. So Sam, why don't you take over?
You can turn it on. Hello, good morning. Yes, we are here to pack 3 great ideas and maybe a news topic into 35 minutes. And so we're going to rush ahead to do that. I know you've all been looking forward to this because you're ready to hear code sections and creative abbreviations, because this is what you love, I know. Our 3 great ideas are going to be qualified opportunity zone investing, second, achieving income tax deduction for family office expenses, i.e. the Linder case, which you may know about, but we'll review some of that. Third, we're going to talk about derivatives and how they might be used in estate planning. And then the big idea, or I should say the news item, is going to be a discussion of the tax proposal that has become public that Joe Biden has put forth. So given that, let's dive in, and the members of the cast here, Argy Sakopoulos is going to be talking about opportunity zones. Brian Dethrow is going to be talking about derivatives. I'll be talking about Linder, and Aaron Tuggle is going to be talking about Joe Biden's proposal. So Argy, let's kick it off. Opportunities.
Hi guys. My name is Argy. I'm an attorney at Jackson Walker. My practice is focused on fund formations, real estate investment trusts, M&A, and most recently qualified opportunity funds, which I gather the audience here has heard about these a few times already. So I'm just going to start out by doing a brief overview to level set and get everyone on the same page as to what this is. It's a tax shelter that Congress intentionally passed into law to incentivize the reallocation of capital gains, of capital deployment, that is, into so-called opportunity zones, which are designated geographic low income, or aspirationally should be designated as low income regions. And the opportunity zone program has 2 major tax benefits, and it's only achieved if you have actual capital gains. So that's the major thing to understand up front, is that what the Opportunity Zone program is a tax shelter for capital gains. That is to say, there are 2 categories of capital gains that receive tax benefits with respect to opportunities zones. The first is that if you have capital gains and you make an investment in an opportunity zone, you can elect to kind of match up that investment with the amount of capital gain that you would otherwise have to report and pay tax on. And as a result, that capital gain is considered to have been rolled over into the opportunity zone fund. You have to set these up as funds. And you don't have to pay tax on that capital gain until 2026, as long as you get the money in before the end of 2021. You also get a 10% haircut on the amount of gain reported, which would then be taxed in 2026 at whatever the capital gains rate in 2026 is. So there is a little bit of a change in law risk if capital gains rates increase before then, with respect to that rollover gain. The bigger benefit is if you can hold on to that investment for 10 years, any new gain that builds up in that investment, or that accretes with respect to that investment, can be disposed of completely tax-free after that 10-year hold. And the Opportunity Zone program first came into existence as a result of the 2017 Tax Act. 2017 Tax Act. But we've really seen it pick up only in the last few months. After a couple rounds of proposed regs that received a lot of criticism, final regs came out at the very end of last year, beginning of this year. And they provided the certainty and stability that I think was really what a lot of people needed in order to move forward with making these investments.
Correctly, and then I'm like, what I wanted to study was completely different from what I ended up studying.
Hold on for a second. Keep it going.
Okay. Anyway, so I just wanted to talk about some of the deals we've been seeing and how the final regs have helped facilitate the structuring of some of these deals. I'm going to keep it really quick. And also, just want to say a few words about what the Treasury has done with respect to COVID. There has been COVID relief for opportunity zone deals. What that means is, I think the two major things to appreciate is that if you have any gains from 2019, that especially ones that were, if they were realized in a partnership, for example, and you can elect to start your kind of rollover window for those gains at the end of the year. Because of COVID, you now have until the end of this year to get any of those capital gain rollovers achieved. If you wait too long and you have to file your return for 19, then you may have to amend your return if you do it like in November and December, but there's still the ability all the way through the end of the year to roll over any of those gains from 19, as long as, you know, they're gains that you were realized in a partnership that you can elect to report at the end of the year or to treat as triggered at the end of the year. The second major COVID relief is that you now have for investments that you fund before the end of the year, you now have 55 months instead of the initial 31 months in final regs to deploy that capital into a deal. Now, opportunity zone deals have to be structured correctly, and they're very persnickety in terms of how they get structured. You have to set up a fund.
Can you hold up 1 second?
Yeah, absolutely.
Can you just rewind on that 55 months versus 35 months clarification? Because there's a nuance there that most people don't know if they're not in the fund already.
Right. So exactly. So if you fund in before the end of this year, then you qualify for a 24-month extension. Final regs finalize the 31-month working capital plan idea from proposed regs, but as a result of, they also provided a force majeure accommodation of 24 months, and that force majeure accommodation has been triggered by the COVID disaster declaration currently in effect through the end of the year. There's a little bit of a cliff effect. If you invest before the end of the year, you get 55 months. Under current law, you invest on January 1st and it snaps back to the 31 months. So
I'm sorry that you're not here in person, because I could probably clarify this easier. But the clarification is that if you invest in a fund, it doesn't have to have a target yet at that point in time. It just has to have become a fund. Is that right? And then it has to invest before 31 months. But under this case, you're saying that it has to invest before 55 months, which is like a 2-year extension almost. Is that right?
I'm not sure exactly what your question is, but yes, you have 55. Well, I didn't want to get into the weeds on the structuring, but if you're doing an opportunity zone deal in a QOZB structure, which most deals are, makes it a lot easier to comply. Then you have to fund a 31-month working capital plan. There's a lot of other things that go into the timing of capital deployment. For example, you have the ability to ignore working cash in the opportunity fund's asset test for 6 months after it's contributed. So say that you put the cash into the fund already, you can ignore it for 6 months, which means you essentially skip the next asset test. But then as long as you get it contributed down into the QOZB before the end of the year, you get a 55-month plan to deploy the capital.
So it's almost 2 years. Got it. So you got an extension because of COVID. Excellent. That was my point. Keep on going.
Sure. Yeah. By the way, when it comes to identifying opportunities, there is a real question that's, I think, still unanswered regarding how detailed your working capital plan should be. I think that the regs intend to give you a lot of flexibility there, because one of the examples in the regs lets you have a seeking opportunities phase for capital deployment.
On the phone.
Sorry.
Keep on going.
Okay. I keep thinking people are asking questions. So let's talk. I think I just have a few minutes left. So I just want to mention some of the deals that we've been seeing. Real estate development is still a major use of opportunity funds. We've seen mixed use development where the plan is, you're going to trigger all your gains, roll them in, and you're going to do a ground up real estate mixed use development, hold it for 10 years and get out with a big pop at the end. If you're getting any kind of management fee, especially if you're getting a carried interest of a qualified opportunity investment, if you're the one if you're on the sponsor side and you're managing it, you're getting a carry, you should be aware that there's, perhaps for the unwary, for carried interest that need a specific structure to avoid having the carry taint any capital gain rollover that you're also putting into the deal. And that was something that we've had to deal with in pretty much all of our sponsor side qualified opportunity zone investments. Final regs did confirm that the structural solution we've been using since the proposed regs came out does work, which is to have a separate carried interest vehicle. That's very important. We've also seen, especially since final regs came out, more of an interest in opportunity zone deals that focus on investments not in real estate per se, but in operating companies, ventures, startups, even one of the more memorable ones was a water hauling business. In fact, let me talk about that one because I think it really helps illustrate how much more certainty and flexibility we have now to structure OZ compliant investments after final reg. In the case of the water hauling business, the idea was you buy a yard where the trucks are kept and you have a headquarters in the OZ. And then even though the trucks leave the opportunity zone to do their business day to day, as long as they're not out of the zone for more than 14 consecutive days earning income, and they're based in the yard in the OZ at night, that's not a violation of the OZ rules. Another very helpful, in particular, the income test. The challenge in that fact pattern is where is the income being generated when the trucks that are generating the income are all over the place, inside and outside of the zone. And so the ability to kind of attribute all that income to the headquarters and treat that all as good income for your OZ funds income test was very helpful. On the asset test side, final regs gave us the ability to aggregate groups of assets in ways that's been extremely helpful. Going back to the water hauling business, there was a fleet of old trucks. How do you substantially improve a truck? You can't, you can put new tires on it, but you can't really double your cost basis of the truck, which is what you have to do under the old rules. Now they let you aggregate your fleet and buy new trucks. And if you spend as much on the new trucks as you spend on the old trucks, and the old trucks are worth less, so you don't have to like double the size of the fleet, you end up qualifying that collection of assets. And given all you have to do is have the new investment improve the functionality of the old investment, and then you can count it as substantial improvement toward the old investment. And when you think about it, you could actually achieve, you can play some games here because you can group assets differently with a lot of flexibility and utilize your 30% bad asset bucket for ones that you're not investing to improve, and get a lot of flexibility in being able to structure an operating business in an OZ, even if it has clients outside the OZ, and even if its assets are not of a nature that can be substantially improved, as long as you can make other investments that you can aggregate with that business. So that's been very helpful in final regs.
And so Argy,
Yeah.
if I could interrupt, I mean, there are a couple special aspects on family offices that might be helpful just for us to point out. I mean, the source of the gains can be, for most of our family offices, you have a portfolio that generates cap gains every year. Each and every year you can harvest that gain and roll it in. It doesn't have to be the obvious, real estate holdings that roll into the next deal. It's any gap. And for that matter, some of our families, if they decide finally to monetize, their modern art collection, that works just beautifully. So it can be anything that you can imagine that generates cap gain. And then the second part that's interesting, Argy, talk a little bit about some of the kind of a joint qualification. For instance, someone earlier had asked about alternative energy. Do you think you can do a family office that's eager for credits that does, say, a solar deal on the family farm that happens to be located in the qualified opportunity zone and still have it QZ qualify?
Yeah, that's a good point. I mean, an OZ fund is a partnership like any other, and so any credits that are generated by the economic activity going on in the fund would be allocated out, under the partnership rules. We've also seen people doing 1031s, or I'm not sure we've actually closed one of those, but we've certainly had planning for future 1031s inside OZ funds. Now you can't exactly combine them fully because, you can't, an OZ fund investment isn't like kind to real estate. But to the extent you roll in the capital gains and then you have a 1031 deal inside the fund, you can do that to keep going to keep redeploying capital without restarting your 10-year holding period.
And so, Argy, how long could I, if I were a family office that really never wanted to pay the gain, obviously I've got to pay my initial gain 7 years later, but if I just want to keep going and let it accrue inside an opportunity zone business, how long does the law let me do that?
2047, I believe. I can never remember if it's 47 or 49. The point is it's decades from now.
So basically, we'll all be dead,
Yeah.
and I guess not you, I know. and the irony, of course, for some of our family offices, they think they've got this incredible thing going with 1031, and they don't think they're ever going to pick it up in income, but that keeps getting narrowed and narrowed and narrowed. And this OZ deal, Argy, does it just keep rocking along?
Yeah, there is a real trade-off between 1031 versus OZ, where the source of the gain is going to be from real estate. You can either do a 1031 and keep rolling on and try to hold it until death, although I think Aaron's going to tell you that the step up in basis at death is a little bit in peril, depending on what happens politically. And if
1031s.
Yeah, and 1031s, not to mention those. But once you're in an OZ, it would be a kind of, once you're locked in and you've invested on that basis, Congress could always take that away. But they always tend to grandfather, at least in my experience, investments where people have kind of invested in reliance on a tax law or a tax shelter program. They'll take it away prospectively, but if you're in, you're in. And obviously that's not constitutionally compelled. You'd have to get into like Eighth Amendment clause issues, but that's what I've always seen happen. But I do want to say, I've had clients who have decided to go with a 1031 because they don't like the idea of recognizing that gain in 2026, which you have to do with the OZ program. On the other hand, if you have any other kind of gain that's not real estate gain, it seems like a no-brainer. If you have any good investment opportunities in an OZ, there's nothing comparable that you can do to avoid paying taxes on that gain. If you get some deferral on that gain, that's great. And then you've got a non-real estate investment that if you hold for 10 years, you can start selling. I don't know if it made different investments, for example. You could sell off pieces of it and take out tax-free liquidity is the point, and be able to.
Argy, now tell me, hold it. You got me at tax-free liquidity. How's that work again?
Well, you just have to hold your OZ fund investment 10 years, and another accommodation of final regs is. Whereas the statute suggests you have to sell your fund interest to get out tax-free, the regs have interpreted that a little creatively to permit the fund or any entity, pass-through entity below the fund, to sell assets. And as long as they're not inventory assets, the gain that comes out, including the recapture, is tax-free.
So, Argy, tell me about other tax-free liquidity. Let's say real estate people love to do a tax-free recapitalization. Talk about that briefly in a QOZ format.
You can, after 2 years, do a recap in which you replace your equity with bank equity and pull out tax-free liquidity in the form of a debt finance distribution. This kind of cribs off.
Now, Argy, does that keep my gain going? So do I still get my tax position?
Yeah, you can. And Brian's point is that doing that doesn't restart your holding period. You can take the cash out tax-free. If you sell before 10 years and you have gain coming out of the OZ, you can either have that gain rolled over inside the fund or pull it out and you can roll it into a new fund. That'll restart your holding period though. Whereas,
but conceptually, I can roll my gain in and basically take all my money out, assuming I've got a willing lender, is your point.
Yeah,
and
exactly.
still keep my tax position rolling on. Say, let me switch quickly on topics if you guys will follow. Sam, is this okay if I roll on to just a short piece on family derivatives?
If you want to jump, yeah, jump to there.
Sure, and this is short, but we thought it might be interesting for you family offices to consider. We are completely respectful. You're much more attuned to the public derivative markets than your tax lawyers ever will be. At the same time, we love the opportunity to consider derivatives not in a public format. Essentially, if you can imagine any transaction that trades off the upside for a purchase price, we can do exactly that same transaction within a family. And I like to start just with the simplest of simple examples. You guys will blow way past this in sophistication, but just assume one of my big family office clients was an oil guy, and he rode the oil stock from 100 down to $10. That was a bad month, and he is utterly convinced that the upside still remains in this public equity stock. And so the concept we proposed was essentially a private synthetic option where we have the younger generation, let's say a trust for the grandchildren. We have a younger generation purchase from G1, the founder of the public company. We have the G3 purchase from G1 the right to the upside. Sounds pretty much like an option that you guys play with every day in the financial markets. And in this instance, my example, you can easily turn in a publicly traded context. You can look in the finance pages and see what a 1 year or a 2 year option might be going for. And in this case, my example, it was $4 and $5. And so for one share of stock, the G3 trust pays $4, but essentially captures every nickel of the upside over and above the $10. That's the current price that trades on the market. Now that's pretty expensive. I mean, by no means is that one that Sam and I would look at you and say, boy, what a great deal. Let's have the kids, or in this case, the grandkids, give up, potentially this significant sum of money and put it back into the taxable estate of the older generation, G1. But when you start to tinker with it, that's where there may be some real headway you can make on moving upside out of G1's estate. We like a total return swap. And using that example, same stock, same dollar amount, same everything. What if G3 in this case purchases from G1 an upside that's not the first dollar? Its current trading price is $10. Let's say we push it on out and say it's every dollar north of $14. What we'd have to hire an econometric modeler, and what would he say that is worth? Let's pick a number and say that's $3, just for purposes of example. So in essence, the younger generation is paying 30% of the underlying value to get the upside over and above, say, a 40% increase over today's value. Again, that's still pretty expensive, and particularly compared to, say, a grantor retained annuity trust that for a point or two a year, I can kind of cream the upside and push that downstream at least one generation. Not in my example like with grandkids, but you can push it at least one generation. But now we're going to tinker even more. And again, this is where the art is. You work with your economist, and essentially come to terms that give significant upside potential, but don't really cost all that much money out of the pockets of the young generation. And so, we're going to document this on a standard ISDA form, and it looks just like any other fancy derivative that's out in the market. It just happens to be within the family. And so we start to really get sophisticated, and we'll say, so what if every upside dollar north of 14, but let's say we're going to cap that upside at 2 times the current value, 20 bucks. And let's say that our economist says the value of that is $1. That's 10% of your current market price of the stock. Now this is starting to make sense. I've got a founder who's convinced oil's coming back. It doesn't cost much in the hands of the G3s. I can get some real significant upside pushed out. Now the other
Brian, Marty Sakata,
yes.
got a couple of questions here. So can you talk about the tax advantage aspect of this, number one, and number two? So if I'm G3 buying from G1, is my purchase of the options tax deductible?
Great question. There's no deductibility, Marty, but the really nifty part is we almost always do this grantor. We use the G3 trusts and make sure it's a grantor trust. And the interesting part for income tax purposes is that it's a quote nothing. Nothing has happened, and instead, the only thing that really matters when you do a transaction like this is for estate and gift purposes, we've successfully moved the upside into the hands of the G3s. So it's a magic zero on your income.
So the actual G3 person is not paying, the grantor trust is paying for this, and the grantor trust has the rights. Is that correct?
That is correct. The grantor trust owns the upside, but guess who the grantor on the grantor trust is? It's the grandpa. It's G1.
Understood.
And from his income tax perspective, what has happened? Zero. And for Sam Hildebrand's estate and gift perspective, we've just moved potentially, in my example, I think we were hoping to move several $100 million of upside out of our, assuming oil comes back and COVID goes away. I mean, I guess those are big suppositions in this market. But the interesting thing, I used the oil stock as an easy example because it's so volatile. And when I came up with these numbers, literally my trading price was $10. I looked it up early this morning just because I was curious, and the trading price is now 60% higher than it was when I wrote this example. And so in theory, if we had done any of this, we would have paid for the effort plus a whole bunch more. And the nifty part about these total return swap transfers of upside is that no transfer of title is required. It's a basic ISDA form. You need a fancy derivatives lawyer for about 5 hours, and then you're done. You can describe real estate, items of real estate in the portfolio. You can describe stock positions. You can describe anything at all, and it's about this long in a document that could be written by a third grader, and you're off to the races. You've now transferred the upside and done it appropriately. So
and that point is also that you can use it for public equities and for private equity holdings.
Absolutely. Partnership interest, hedge funds, private equity funds, direct investment pieces for most of our family offices are perfect candidates as well. And I'll end on that. Tim?
And Brian, the risk with that, since it is an estate and gift tax play, really, is that the IRS will challenge certain parts of the transaction or perhaps even the valuation. And what we've done a bit of a survey on that, and the IRS tends to not challenge the contractual piece of it. They seem to accept that, and it's really more there's really more of a possible challenge on the valuation side, which you would expect because this is a fairly unique concept, and we come to the table with an economist and appraiser to deal with it, and the IRS may not be used to seeing this kind of a thing in the gift and estate tax context.
All right, so before we move on to Aaron, my only comment is, because we've done a lot of stuff with 1031 exchanges and opportunity zones, is that and we used to do a lot of stuff with 1031 exchanges and art, and that went away with the most recent Tax Act. So 1031s have been narrowed from all different types of collectibles to only real estate at this point in time. Is that correct?
Yes.
That's correct. And that's what happens when you have a real estate office, right? Yeah.
Right, there you go.
And I guess
Right.
the real estate guys got, Marty, the real estate people got nicked a little bit on the Tax Cuts and Jobs Act at the end of 2017, because if they came in and bought a building and they did a cost seg study that said 15% of this is actually personal property, and I'm looking at in my home, the light fixtures and the stuff that's not attached to the building, that's not personalty, and that won't roll in a 1031. But everything else, the basic building does. But that's all that's left.
Now, my understanding, and it's been in other Democratic platforms before, is that Biden's platform is looking to get rid of the 1031 exchange. And I don't know what's going to happen with Biden and opportunity zones as well. So I just wanted to kind of segue into Aaron.
Yeah.
And I think Aaron's going to
Aaron, go ahead.
So Aaron?
May I go ahead? Okay,
Yeah,
sure.
go ahead, Aaron.
That is one of the proposals, and what I wanted to kind of start off with is say that this is generally like a high level. This is what Biden's proposals are. We all know that these are not, in the weeds specific. A lot of these are kind of campaign talking points. And in addition to not knowing if Biden will win the election, we also don't know what the outcome is going to be for the Senate and the House. So all of this is just, what he is proposing. And so we don't really know. But I will say that, looking over the proposals, and generally we can think that what President Trump would say is essentially he wants everything from his 2017 Tax Act to become permanent. So we're really just kind of looking at what would Biden's proposal be. And so I'm going to start with kind of the business and the corporate tax proposals. As you guys probably will recall, we had a 35% corporate tax rate. The 2017 Tax Act brought it down to 21%. Biden's proposal is to kind of split the difference. He's proposing a 28% corporate tax rate. He's also proposing a 20% repeal of the 20% pass-through deduction, also known as the QBI, qualified business income, for taxpayers over $400,000. That $400,000 is going to come up a couple of times, but so essentially you still get that QBI pass-through deduction for pass-through income unless you're over $400,000 in income. He also wants to repeal the special qualifying rules for that are kind of geared towards real estate, so mainly REIT dividends. And the other big thing that's already been alluded to several times is that he wants to repeal the like-kind exchange deferral for real estate. As it's already been mentioned, the 2017 Tax Act repealed like-kind exchanges for personal property and left in place the real estate. And so this would essentially also do away with the real estate 1031 exchange. That's even more painful when you think about some of the changes to the individual income tax proposals that he has, namely that the capital gains tax rate would essentially not be 20%. It would, for anyone over $1 million in income, he is proposing that it would be ordinary income. So you're looking at a 39.6% ordinary income tax rate, because for the individual income tax, he wants to go back to pre-2017 tax rates. And because let's say there's a capital gain of over $1 million, that capital gain would also be subject to the net investment income tax from the Affordable Care Act. So you would have possibly a 39.6% ordinary tax rate plus 3.8% Affordable Care tax, net investment income tax rate. So you're looking at over 40% tax rate for capital gains income, which is historically, always been favored, and so that's not probably likely to be palatable for generally for I would think for a lot of folks even who don't necessarily have a $1 million income on their tax return. He also there's a unique proposal that he's saying on the payroll tax. So as everyone knows, the payroll tax is essentially split half and half with employers and employees. And right now we have a payroll tax that stops at about $137,000 of income. And so both the employer and the employee quit paying that's their share, the 6.2% on their wages, up over $137,000 and change. Biden is proposing that once the wages go over $400,000, it comes back into play for both the employers and the employees. So you have kind of this, I've heard it referred to as a donut structure, where you have the payroll tax on the first $137,000, and then there's no payroll tax, and then once it goes over $400,000, it comes back into play. And so that is a proposal that he has. And then last, I want to just kind of hit on the estate and gift tax, which is kind of the bread and butter for Sam and I. Is that Biden's proposal is that we do go back to the historical norm. I think that's a ironic term, since there's been so much change in the estate and gift tax exemptions over the last 10 years. But most people understand that to mean a $3.5 million exemption per person, not the $5 million that came in 2010, but that it's not the doubled amount from the 2017. So we would go back to a 3.5, which right now we're at 10 million indexed for inflation beginning in 2011, which means we're at about 11.5 million through 2025. So it's a pretty significant reduction, going from going down to 3.5 million. Biden's proposal is also to eliminate the step up in basis for inherited assets. That has been proposed many times by Democrat candidates. It is generally thought to be very unworkable and hard to implement, but it is out there, and it's definitely a chance that they will get this accomplished. One thing that has been thrown out, we've had a couple of clients ask about the so-called wealth tax. I don't want to go into a lot of detail about it. I want to leave some time for Sam, if he can, talk about Linder. But the wealth tax is generally an asset-based tax. Like annually, it's been proposed by candidates Elizabeth Warren and Bernie Sanders. Biden does not have a proposal for a wealth tax, and so the general thought is that he would not propose that. And so it's not something that we're thinking is going to be out there, but it's generally the estate and gift tax reductions that we're concerned about. And just to wrap it up, what this really kind of means, I think, for family offices who make investments and who might have liquidity events or might have a shifting of wealth, is that any changes that come into effect are likely not going to come into effect until 2022. And so there'll be a year or two where we will be able to do some implementation of estate tax reduction strategies, looking at whether or not liquidity event makes more sense right now, looking at some of these, like if 1031 is a possibility that we're planning for and we can't get it accomplished in the next couple of years, then maybe we go with a different strategy because we don't know if 1031 for real estate is going to be around. So just kind of planning ahead. These are all things that we need to consider in advising our clients, like family offices and individuals, and just know that we'll have some planning time. So, and none of this is certain. It's all, talk right now.
So what I wanted to add for Erin's point about the timing, I think she's just trying to not have an amazing amount of work in the last 5 months of this year. That's the whole purpose, right, Erin?
Well, that is the purpose. Sam knows, and no one else probably does, is I have a 4-month-old that came at the beginning of COVID quarantine. So I would like to not have a crazy rest of the year. It's already crazy enough.
But I'm afraid, Erin, Yeah, my only other option is to die now, and I'm just not finding that a palatable client option.
It's not a popular advice to give to clients right now, so.
All right.
Sam,
Thank
can you
Greg.
just quickly cover lenders? I think that'd be a great topic for this
yes.
kind of
I'll
audience.
just finish up. We have just a minute or two left, and I'll just say a couple of things. You know, we all work with family offices. That's what we're here for. Family offices should get a deduction for the expenses they have. Some clients are shocked when they think that that's even a possible loss for them, but it is. And the reason for that is traditionally an individual or a family who's trying to produce income would have a significant cutback on the deductibility of the expenses they incur to do that, if not a complete elimination of it. And so how do you get around that loss of an important deduction? And just so you know, if we look into the future and say we have 43% ordinary income rates, we want all the deductions we can get, right? And so this becomes more and more important for us because the deduction will save us whatever that rate is times the income that we have. So the key to this is the family office, if it's going to be offering services and being compensated for it, it must be deemed to be engaged in a trade or business. That's the key. That's what the Linder case tells us. Unfortunately, and this is Linder Management versus Commissioner, came out in 2017. I'm sure that many of you have read it and studied it and know what it says, but just wanted to cover it briefly. What it says is that if you structure the family office correctly, you have an opportunity to achieve that deductibility of those expenses. And when I say expenses, what are those expenses? Well, they are the investment-related fees that are being charged for the investments going on. And they are also, well, they're not limited to just those investment fees. They're also all of the compensation for family office managers, profit-sharing plans, general office expenses. All of that can be deductible if the family office qualifies as a trade or business. Linder gave us some guidance, and I'll just throw out a little bit of that. The one thing that the family office must have to achieve trade or business qualification is a profit motive. And Linder looked very specifically at how the family office was being compensated. Was it just being reimbursed for its expenses? If it is, that's not a profit motive. And that's not going to help the family office be a trade or business and achieve deductibility. The compensation structure for the family office should be put in place as a profits interest in the underlying investment entity. We typically form limited partnerships as the family office structure. We have the investors who are the family members, family trusts, maybe third parties. They are the limited partners, and the general partner is the family office. The general partner does not have an economic interest or an ownership interest in the partnership. What it does have is this compensation right, and we design that as a profits interest or a carried interest, so that if the family office helps the partnership earn income or increase the value of their assets, then there's a percentage applied against that increase, and that's what the family office is compensated on. So that helps tremendously. A second point that's important to achieve this deductibility is differentiation in ownership. The owner of the family office should not be the same as the owner of the investment entities. Okay. In Linder, we had the primary owner of the family office structure was Keith Linder, and he owned 99, well, through a trust, but he owned 99% of the family office. He did own some of the investment pieces, but the most he ever earned in any one year was 17%. And that was deemed to be enough differentiation and interest to allow the lender family office to qualify as a trader business and achieve the deductibility. Couple more points on that. When we are designing the owner of the family office, we typically have the family consider forming a trust, perhaps for future generations, maybe grandchildren, maybe great-grandchildren, depending on how old our clients are. And that trust owns a family office, and we designed the family office to make this profit so that we're actually transferring wealth down to that younger generation, free from the transfer tax system. All right. The third point that is important in structuring these family offices to achieve this deductibility is to have them perform the kinds of services that a multi-family office organization would provide. Surely a multi-family office that provides services to several families, that's a trader business. They're in it for profit. And there's little doubt about that. And so when we're forming family offices, we ought to be doing the same thing, provide those kinds of services. Let the family members who are investing at the investor level, let them be able to withdraw funds regularly. Have our family office people meet with the investors regularly and understand what their condition of life is and what their risk tolerance is, things like that. And then last, make sure that the family office is offering enough investment choices to be able to present those to the family. Those are the kinds of things that a multifamily office does, and I think that if we structure our family offices like that, we have a better chance of achieving this deductibility. So that's real brief on Linder, and I think that's it for our panel.
Oh, thanks so much. And actually, I'm going to clap for you guys. Great job. Thanks. Great. So we're going to get started on our next panel, and that's going to discuss emerging strategies and manager selection. As I said earlier,